let's jump right in. Welcome to this explainer. Today, we are going to demystify something that honestly looks like pure chaos to the untrained eye. The daily up and down, seemingly totally random movements of the stock market. You know, you see that ticker tape flashing red and green all day, every day. But by the end of this, we're going to decode exactly why those stock prices change daily, and more importantly, how you can actually use that knowledge.
Okay, let's dive into this. It's kind of the ultimate question for any investor, right? Why is a company worth one price on Monday and then a completely different price on Tuesday? Well, the answer lies in this fascinating intersection. It's a mix of deeply ingrained human psychology and, frankly, some very hard, undeniable math. So we're going to break down both sides of that coin. Here's our game plan for today. We'll cover the engine, which is supply and demand, then the anchor of company earnings, and the wild cards like sentiment and news. After that, we'll look at our two profit engines, capital appreciation and the dividend. Finally, we'll wrap up with how to manage that daily market risk.
Starting off with Section 1, the engine, supply and demand.
So before we even start talking about complex business strategies or macroeconomic policies, we have to look at the absolute most basic surface mechanic of the market. At its core, it's literally just an invisible scale. When a company launches a massively popular product, buyers flood in demanding shares. But if the number of available shares is low, boom, the price goes up. Conversely, say a business is rocked by a scandal. Panic selling floods the exchange, creating way more supply than demand, and the price falls. It really is that simple. Supply and demand dictate the price you see on your screen at any given second.
Moving on to Section 2, the anchor, company earnings.
Now, supply and demand definitely move the price today, but what actually drives that underlying demand over the long haul? Like, what makes investors want those shares in the first place? Now, what's really interesting about this concept is how it totally changes our perspective on value. Comparing just the share price of two companies is actually pretty meaningless. Think about it. If company A trades at $100 but only has 1 million shares, it's worth $100 million. But if company B trades at just $50 yet has 5 million shares, it's worth $250 million. That total value is the market capitalization, or market cap. That is the true reflection of what the market thinks a company is actually worth.
And what drives that true value? Earnings. Earnings are the anchor here. Listen, in the long run, no company survives without profit. Take NVIDIA, for example. By reporting 12 consecutive quarters of revenue and earnings beats, they massively reinforced investor confidence. And what happened? The stock price naturally climbed. If a company consistently grows its sales and its bottom line, the demand for its stock, and therefore its price, is basically guaranteed to rise over time.
All right, Section 3, the wild cards, sentiment and news.
So if long-term earnings are the anchor, why do prices whip around so violently from day to day? Well, that's because of these rapid-fire triggers happening constantly. We're talking mergers and acquisitions, Wall Street analyst upgrades, company insiders suddenly buying up their own stock, massive short squeezes, institutional investors rotating money between sectors, or sudden regulatory wins. These wildcards can cause massive, immediate price swings long before a company's fundamental earnings actually catch up.
To see this in action, just look at some of these incredible micro-stories. Remember when Elon Musk disclosed his intent to acquire Twitter? The stock spiked purely on the expectation of a buyout premium. Or look at Palantir. Investor excitement around AI surged and boosted the stock, even when their actual earnings were just sort of mixed. Or, the ultimate wildcard, retail traders triggering those massive short squeezes on GameStop. They sent the stock far beyond its fundamental value simply because short sellers were forced to buy shares to cover their bets. That's sentiment and news moving the scale.
Let's get into Section 4, Profit Engine 1, Capital Appreciation.
Now that we know exactly why the scale tips and prices move, how do you actually capture value from this? Well, the most standard approach is a long position. You buy a stock, hold on to it, and ideally the company grows, demand rises, and you profit when you sell it for more than you paid. The exact opposite of this is the short position. Now, this is a much riskier bet used by experienced traders. They borrow a stock and sell it, completely anticipating the price will drop so they can buy it back cheaper. But if the price rises instead, they lose money. So for most of us, going long is the foundational strategy.
Next up, Section 5, Profit Engine 2, the dividend. But hey, what if the stock price stays completely flat for an entire year? Welcome to the dividend. This is a profit engine that pays you without you having to sell a single share. I absolutely love the apple tree analogy for this. Just imagine your share of stock is an apple tree. Every season, the tree grows apples. Those apples are the dividends, a portion of the cash flow the company basically sets aside and divides up among its shareholders. And the best part? You do not have to chop down the tree, meaning, sell your stock, to get the apples.
The tree stays standing, and the cash just magically arrives in your account.
And this brilliantly illustrates the magic of what you can do next. You really have two choices here. You can eat the apples, meaning take the cash dividend and just spend it, or you can plant the seeds. Through a dividend reinvestment plan or a DRIP, you automatically use those cash payouts to buy more shares. More shares mean more trees, which means even more apples next season. This creates this incredible dividend snowball effect, automatically compounding your wealth over time.
To measure exactly how many apples your tree is giving you, we look at the dividend yield. You just take the yearly dividend and divide it by the share price. So if a $100 stock pays $4 a year, that's a 4% yield. It acts a whole lot like the interest rate on a standard savings account, helping you gauge exactly how much cash your investment is going to produce year over year.
Finally, Section 6, Managing the Daily Market Risk.
In the real world, market frictions can easily eat up these profit engines if you aren't careful. For example, 30%. Just let that number sink in for a second. That massive 30% is the current dividend withholding tax rate for a non-filer in Pakistan right now. A non-filer receiving 100,000 rupees dividend instantly loses 30,000 to taxes. It is a stunning example of how much profit simply vanishes into thin air without proper tax planning and compliance.
So the crucial point here is that understanding the rules is what protects your wealth. Governments actively incentivize you to participate properly. Look at these comparisons. By simply filing your taxes, that 30% dividend tax gets slashed in half, dropping down to 15%. Furthermore, if you hold your stocks for longer than 12 months, your capital gains tax drops to 12.5%. They are literally paying you in tax savings to be compliant and to hold your investments for the long term.
Now, aside from taxes, your own behavior is a massive risk. You have to avoid trading too often. I know, with these sleek online platforms, it kind of feels like a video game. But frequent day trading will quickly eat up your profits in fees, commissions, and short-term taxes. And you absolutely must avoid emotional investing. Panic selling during a really hot, emotional market day, yeah, that's a virtually guaranteed way to lock in a permanent loss. Real success comes from keeping a cool head when the market gets chaotic.
Let's move to how this builds a complete picture. On one hand, you've got capital appreciation, which is driven by growth in market sentiment, allowing you to ride those massive price surges. On the other hand, you have dividends, driven by actual, hard company profits, giving you that passive income snowball. By balancing these two strategies, you completely transform the daily volatility of the stock market. It goes from this scary, unpredictable force into a highly logical, long-term wealth-building system. So you now know why the scale tips daily, how earnings anchor the long-term value, and how you can actually capture that wealth while minimizing your risks. I'll leave you with this final, provocative thought as we wrap up. When you look at tomorrow's chaotic, flashing market ticker, will you look at it with fear, or are you prepared to view it with strategic understanding? Keep learning, keep your head cool, and I'll see you in the next explainer.